Welcome back, guys, to another episode of the Genesis Block podcast. Today, we have for you another thematic analysis, this time on MEV or minor extractable value. So today we have Siddharth presenting for us. He's gone through a lot of material on the various aspects of MEV, and then he present to us, and Yash and I will try to fill any gaps that might find, or any doubts that we may have, to make it as clear as possible for you. So with that, Siddharth, over to you.
Cheers. Thanks, Sid. So the first thing that I'd like to correct actually is that now it's called maximal extractable value rather
Oh,
than
okay.
rather than minor extractable value. I mean, it's fine because like that was the original term that the authors came up with in Flash Boys 2.0. So that was the research paper. That was the academic paper that was produced by Phil Dayan and a bunch of other people working on the Flashbots, on the Flashbots team, which is a team that's dedicated to solving the problem of maximal extractable value on primarily first the Ethereum blockchain, but also it's a problem that's present across all blockchains. So they're trying to solve for this issue from the ground up, right? But what exactly is maximal extractable value? So this is a term that's been coming up more and more recently, especially over the last few months or a year, and MEV is essentially one of the core tenets of understanding how the Ethereum blockchain and transactions on Ethereum actually work. So if you understand how transactions on Ethereum work, then you'll be in a much better position to understand what exactly MEV is. So I don't want to, confuse the listeners with any sort of definition as to what MEV is before, we go through how exactly an Ethereum transaction works today. And you can take this as a transaction on any other blockchain as well, although the design decisions and trade-offs mean blockchains have slightly different, or in some cases significantly different methods or manners in which transactions go through. But let's go through an example of how an Ethereum transaction works, and then let's actually understand what MEV is about, right? So let's say that Alice buys an NFT from Bob for 1 ETH. So that transaction is then submitted to the blockchain to be validated and then mined in a block. So the way that works is that the transaction is gossiped. So gossip means it's sent, right? So the transaction is sent to all the nodes, which are run by miners right now. But after the merge, which is scheduled to happen in a couple of weeks, it will be sent to the validators. So the transaction is sent to all the nodes run by miners who validate and mine the transactions. Now, every transaction includes a gas price. So the gas price is the amount that the sender will pay in ETH as fees. So the gas price multiplied by the units of gas consumed, it equals the transaction fee paid in ETH by the transaction sender to the miner. So before transactions are included in a block, they go into this essentially in this thing called a mempool or a memory pool. So a mempool, you can think of a mempool as a list of transactions that are waiting to be confirmed and added to a block, right? So let's run through the process from the start. Alice wants to Alice buys an NFT from Bob for 1 ETH. That transaction is submitted to the blockchain, and is then sent to all nodes run by miners to be validated and then mined. Each transaction is then included in this mempool, right? So the mempool is a list of transactions that's waiting to be confirmed and added to a block. So each miner can see the gas price of each transaction, right? So it's publicly available for the miner to see. And the miners create a block that maximizes the value that they receive through transaction fees. So let's go through an example, right? So if there are 15,000 transactions waiting to be included in a block, and let's say that the maximum number of transactions a block can hold is 10,000, then the miner will run an algorithm that that essentially takes the 10,000 transactions with the highest fees, So the miner essentially takes the transactions that maximize the amount of value that they will get out of validating these transactions. So what does that lead to, right? So that essentially leads to transaction submitters wanting to get who want to get their transactions validated first and included first. They bid against each other in the form of higher fees, right? So let's say that the three of us are submitting transactions on Ethereum, and Yash wants to get his transaction submitted first. So what he'll do is that he'll bid up the price of the he'll bid up the transaction fee that he's willing to pay in order to get his transaction included before mine and Sid's, right? And then Sid looks at that and goes like, oh, I want my transaction to be included before Yash's. So he bids an even higher price. So then and then Sid's transaction is included above Yash's transaction, and then my transaction will come last, right? So this bidding for block space is public. So this is good in terms of privacy and decentralization, but it's also bad because obviously if everyone can see the gas prices, it can lead gas prices to be very volatile, and the increased load on the network just it can just overwhelm the network at times. So you can see, in times of high activity, like for example, when the Bored Ape Yacht Club, they were selling the other side land auction. That time the gas prices went up super high, and it's because people who are bidding higher and higher transaction fees in order to get their transactions included on on the block that confirmed their purchase of the other side land before everyone else's transactions could get confirmed, right? So another problem is that failed bids still consume gas. So that means that, let's say that like the three of us have submitted a bid for the same thing, and mine and Yash's bids fail, and Sid's bid goes through. My transaction will still pay a gas fee. Yash's transaction will still pay a gas fee, and that gas fee will still go to a miner, right? So that means that that someone who pays a lot of who's bid a high amount, right? Let's say the second person in that auction pays an insane amount of money, and then they get the worst of both worlds. They lose money, and they don't even get their transaction validated, and it doesn't even go through first. So roughly, this is what a transaction on Ethereum consists of, right? And it's very important to understand this to understand what MEV is. So, but I'll stop here to see if you guys have any questions about just what I walked through, because it's a very critical component of what we're going to be going through next.
Right. So I have one question. So for like someone to make a profit of MEV, it would only make sense for them to be a miner, and then they capture the profit from the gas fees from people whose transactions are not getting authenticated, right? Because if I'm just someone who's paying a very high transaction fee to make sure someone else's transaction doesn't go through, like I'm not going to make a profit anyhow, right? I'm just paying a very high gas fee to a miner. So it only makes sense for a miner himself to pay this high gas fee so that you get free gas from people, but also you don't have to let their transactions go through, right?
Yeah, I mean, and we'll go into some of the ways in which MEV and in which these gas prices and in which essentially transactions are captured in order for miners and validators and other actors actually, right, to make a lot of money. So let's delve into that in a second in terms of like how exactly MEV works, and then this question will become more pertinent.
I have a question
Right.
I have a clarification that I think we should make on Ethereum transactions. So towards the end, when you were talking about failed bids, um, is it so that failed bids only happen when there are multiple people trying to transact for the same item?
Yeah.
So what I mean by that is, if there is, so the mempool can have transactions of all types.
Mhm.
But if the, say, a transaction is, say, of me sending money to someone else, that essentially will not get failed. It will just maybe take longer, but it will never get.
Yeah.
It'll only something can fail only if there is, say, 5 people or how many people purchasing one item.
Exactly.
In that case, there can be a failed transaction.
Exactly, right. So like the example would be, again, like let's say that there's an NFT that's coming out that's super valuable, and everyone wants that NFT, right? It's like it's like, a premium edition, I don't know, artifact NFT, and everyone wants it. And there's only one of it, so everyone bids for the same thing, but the person with the highest transaction fee essentially will go through. So like the amount of money that goes to the miner will determine whose transaction gets
Yeah.
validated first. So then whoever's transaction for that same item doesn't go through, they still have to pay gas fees.
Yeah. And as a corollary to this, in an example of say a fungible token, right? Say a swap when you're swapping on a DEX, um, if there are multiple people swapping on the same two token pairs, right? Then the transaction can fail only if the let's say the transactions that happened before that happened before you in terms of the block itself, if that affects the slippage, if that goes above the
Yeah.
slippage amount, then it will fail.
Exactly.
Otherwise it won't fail.
Exactly, right? Or like, if you, for example, I mean, on dexes, you can't always put limit orders, but for example, like let's say that you put a limit order in, and a bunch of other people's transactions have gone in above yours, and they've caused the price of the asset to materially change, and it goes above or below your it goes above your limit order, right? So then in terms of that, the transaction won't execute, and your bid will fail. But yeah, like that's essentially what will usually happen, is when it's falls below your slippage amount, then your transaction will fail.
Got it. Otherwise, if it doesn't fail, you might just get a worse off deal as you might have if there wasn't any.
Yeah,
Say,
exactly. So like usually, like, yeah, so there's a particular type of MEV attack that focuses on this.
got it.
Again, we'll go into that in a second, but essentially, yeah, like you'll just execute your transaction at a worse price.
Understood.
Cool. Um, okay, so just like before, so let's just dive into what MEV actually is, right? Now, a parallel to MEV in the traditional finance world is high frequency trading. So high frequency trading was made popular by Michael Lewis in his 2014 book Flash Boys, and it's a form of algorithmic trading that conducts huge numbers of trades within seconds. So they attempt to make a small profit per trade, mostly through arbitrage. So all of this trading is done by bots, and these bots execute transactions in 1/64 millionth of a second. So the way that this links to MEV is that MEV also exploits risk-free transactions by using the core features of the blockchain that it is built on, right? So similar to the bots used by these high-frequency traders, the MEV arbitrage bots, they monitor the list of pending transactions in the mempool, and they try to exploit risk-free profitable opportunities that are created by them. So let's say that like I'm an arbitrager, and I have identified a transaction that on two dexes, right? That that'll make me a risk-free profit. So let's say the price of Ethereum on Dex A is 1,000 pounds, and the price of Ethereum on Dex B is like 1,010 pounds. So what I do is I buy Ethereum on Dex A, and then I immediately list it for sale on Dex B. So and I want both those transactions to be included in the same block. So that means that the price discrepancy stays, right? And then I can essentially profit off the 10 pound difference that is there between the price of the same asset on both exchanges. So because it's the same asset, the profit that I make here is risk free, right? So what these arbitrage bots do is that they look through the mempool and they say, oh wow, this is a transaction that has absolutely no risk associated with it, and it's just pure profit, right? So these are pure revenue opportunities. So what bots do is that they compete against each other in priority gas auctions. So these are called PGAs, and they bid up transaction fees, like we said before, to ensure that their transactions defeat those of other bots and are executed and included in the block first. So because their transaction will be done first, that means they'll be the only one to capture the profit, right? So essentially, this is just a form of front running, and the losers are usually regular users, right? Um, and all of this is possible because of the latency of trades on dexes. So if you want to define MEV, you can define it as the total amount of value in ETH profits that miners can extract from smart contracts by manipulating transactions, right? What miners do is that they have an ability to order transactions. So when a transaction is in there are these 10,000 transactions, 15,000 transactions in the mempool, and a miner has to select 10,000 transactions to be included on the block. What this inherently gives them is the power to order these transactions. So what they can do is they can reorder users' transactions and insert their own. So let's say that the miners look at this mempool and they go like, okay, there are 10,000 transactions, and they've created these bots that look for transactions that are pure revenue opportunities. Now, what they do is these bots tell the miner, oh, look, there's a transaction that is a pure revenue opportunity. The miner creates their own transaction to mimic that pure revenue opportunity. And what they do is they try to insert their transactions in front of other in front of the regular user's transaction, right? So then they'll gain the profit in ETH. So for example, imagine an arbitrage bot that discovers a pure revenue opportunity. So other bots will then identify this opportunity. They all bid against each other to get their transaction included first. The miner then finds these transactions, includes that transaction first, and claims both the revenue opportunity and the gas fees bid by all the losing bots. So what these fees are, the cumulative fees, you can call them as ordering optimization fees. So these represent the MEV that miners or slash attackers can get from manipulating the order of transactions, right? So that's in a nutshell how the concept of MEV works. Now there's some things to keep in mind, right? So firstly, attackers will try to execute the transactions with higher trader activity due to the higher volume of transactions that can be targeted. So obviously, like when there are more transactions, there's a higher opportunity of finding risk-free opportunities and essentially exploiting those. So attacks will likely take place when gas prices are higher. Then attackers make sure that any price change due to the MEV attack does not exceed the slippage value that's inputted by the transaction submitters. So let's say the transaction submitter has said that on a transaction where the execution price is £100, the maximum amount of slippage they'll tolerate is 2%. So the attackers will make sure that the execution price does not slip below £98, right? So that means that the transaction still executes, but the miner is the one that captures the value. And the reason that the regular user has received a worse price is because the miner has manipulated that transaction and taken the profits. And therefore the price of that asset has dropped to £98. It's not exceeded the slippage value, so it's not like 97 pounds 99. That in that case the transaction won't execute, right? It won't go through. Attackers also ensure that the losses they incur from paying higher gas fees are covered by the profits that they gain. So like in this case, right, let's say that the profit a miner makes is £2 or an attacker makes is £2. They'll make sure that the gas fees that they pay are lesser than £2 so that they at least earn some profit from this. And there are some types of tokens that are more susceptible to MEV attacks and some less so. So those more susceptible are NFT related tokens and meme tokens, where prices are more volatile and the price activity is much more speculative, and their price elasticity is extremely high. So any change in price causes extreme increases in trading activity, right? Tokens that are less susceptible include security tokens or classic tokens like ETH. So the opposite. So where price elasticity is lower and trading these tokens is relatively more predictable, so volatility is lower. So that's essentially how what you have to keep in mind around these MEV transactions. But again, I'll stop you for a second because obviously this is not very straightforward stuff. So if you guys have any questions, I'll try to take them now and then move on to understanding the types of MEV attacks.
No, I think I'm good. You kind of explained it pretty well right now. So I think we should just go forward to the different types of MEV attacks or methods that miners / takers use.
Sounds good.
I have one question. So I mean, first, the priority gas auctions you mentioned, those are just gas, like what we colloquially call gas wars, or is it a
Yeah,
specific concept?
that's, I mean, essentially what it is.
Okay. And so MEVs is just it. I mean, you can only have like MEV only exists when there is an existing arbitrage opportunity through, let's say, like you mentioned on when traders are swapping between tokens. If there's a existing arbitrage opportunity, only then MEV can come into the picture. Otherwise, there is no such concept of MEV. Is that a correct understanding?
I mean, it's not only arbitrage, but yeah, I mean, like when there's essentially opportunities for miners to extract value from a user's transaction, that's when MEV comes into play. Arbitrage is usually the situation in which this is most prominent. But like, for example, it can happen even in the case of even in the case of like a regular transaction. Let's say that it doesn't need to be arbitrage, right? Like, for example, let's say that like you've discovered an NFT that is that's very valuable, and you've discovered that it's available in the market after like a certain amount of time, and you're bidding for it, and then a miner notices that transaction and says, oh, like this is the value of the transaction. And then, like, for example, okay, let me play this through an example. Let's say that like there's a Bored Ape NFT that's for sale at a price that's much lower than the floor price, right? So someone's put in like an erroneous bid, or like an erroneous sell order. So let's say that you notice that, and you go like, oh my god, I'm going to buy this like Bored Ape for like 1 ETH, because that's way below floor price. So now the miner, or like an MEV bot, can essentially notice that, oh, this NFT is available in the market for much lower than it actually is, than the floor price. So there's a big discrepancy, and this person's already put an order in for it. Now what I'm going to do as a miner is that I'm going to insert my transaction before the NFT bidder's transaction, and then capture that NFT for myself. So that's the type of MEV attack as well, because you're kind of as a miner, or like as a validator, you're using your power of looking at what is available in the mempool to actually disadvantage a regular user who's not really seeing these transactions in the mempool. So you're extracting value from them,
Okay.
It's
right?
basically, I guess it's front running, right?
Yeah, it's
Um,
front running.
yeah.
It's very similar to like the things that happen on Wall Street as well, or like MEV is like not exactly like high frequency trading, but it's best to kind of put it parallelize it with high frequency trading.
I mean, I
And the
guess the difference is that with high frequency trading, what matters is how the transactions are ordered and who puts in their bid first. While
exactly,
with Ethereum or any kind of blockchain, it's about who pays the most gas, and according to who pays the most gas, they'll get their transactions
exactly,
included in the block. That's the only difference,
exactly.
really.
Yeah, exactly. Cool. Okay, so let's go on to the different types of MEV attacks, right? Um, So almost all MEV attacks are conducted using either one or a combination of these next few methods. So firstly, it's destructive front running. So what happens? So in this case, if the attacker front runs the victim, and the victim's transaction fails, so that's destructive front running. Tolerating front running is where the attacker ensures that the victim's transaction executes successfully. So, this is necessary for a type of attack called a sandwich attack, which we'll go through next. Back running. So back running is where the attacker executes their transaction after the victim's transaction executes. So this is cheaper than front running because the attacker does not engage in bidding up gas prices. And the last one is clogging. So the attacker clogs the blockchain with transactions to prevent users and bots from issuing new transactions, right? So these are the four methods that most types of attacks employ. Now, what are the different types of attacks, right? So the first one is just a simple arbitrage attack. So miners monitor new blockchain state changes, and they execute arbitrage transactions when the difference between the price of the same asset on two separate markets is higher than expected transaction fees. So it's the same example that I gave before. So let's say that ETH is priced at one ETH equal to £1,000 on DEX A, and one ETH equal to £1,200 on DEX B. The trader can buy ETH for £1,000 on A and sell it for 1,200 on B for an immediate risk-free £200 profit. So if gas fees are lesser than £200, it makes financial sense to execute this transaction. So attackers can do one of two things. They can monitor the confirmed blockchain state. So when the transaction is included in a block, so when a new block is received, the attacker destructively front runs all market participants in the next received block. So their trades fail and only the attacker's transaction goes through. And the next thing that they can do is that, or like one of the two things that they can do is that they can monitor the mempool. They find large pending trades which can cause the price of the asset to significantly change on an exchange. So the attacker then backruns this trade with an arbitrage transaction. So let's say that assume that an attacker notices an order to buy £1 million of ETH for an average price of £1,000 on DEX A. So this will cause the price of ETH on DEX A to increase to £1,100, right? So after this transaction goes in, an attacker can buy ETH for £1,000 on DEX B and then sell it for 1,100 on DEX A, and they make a risk-free profit of £100, right? So that's that's another method of how these arbitrage transactions can work from an attacker's perspective.
The profit, though, I mean, just to be clear, the profit is the difference between the two trades minus the gas fee. So I mean, it would have to be. It would have to be in a time when gas fees are low. Yeah. Right.
I mean, it depends, right? Like if it happens right now, for example, when gas fees are lower, then it makes financial sense. I mean, these are all these are all financial.
Yeah, I guess the example we're using is very, like basic. It's just general, it's basic. Yeah, actually, it would be a lot more tight kind of values, and they'd be making a very, it would be a very small profit they're making.
Yeah. Like I mean, it depends. Like, yeah, you would usually make smaller profits. But in some situations, your profits can be really high. Like, it just depends on the
or you can trade a lot of ETH instantly, right? Like we're saying ETH is 1,000 and it could be 1,100. But if you buy like say 100 ETH, then your profit becomes 100 times
exactly
what the example we're talking about. Yeah.
Exactly. Right. Cool. So that's the first type of attack. The next one that we can go through is a sandwich attack. So in a sandwich attack, the attacker places two transactions, one right before and one right after the victim's transaction. So let's say that the victim wants to buy ETH on DEX A. So the attacker first inserts a transaction to buy ETH on DEX A for £1,000 per ETH. So what this does, it increases the price of the victim's transaction to 1,100 per ETH. The victim then buys that transaction at this new higher price, which further pushes up the price of ETH to £1,200. The attacker then sells the ETH on DEX A for £1,200, and they make £200 of profit. So this act of inserting a transaction before and after the victim's transaction is known as sandwiching, right? So there are two things that the attacker needs to do in order to pull off this sandwich attack. So firstly, they need to be able to identify large trades. So the attacker either looks for pending transactions in the mempool, or they look out for information from miners that signal all incoming transactions or just profitable transactions. So these profitable transactions are those which cause material changes in asset prices on exchanges. And they also need to be sure that a victim's transaction will be placed between the attacker's two transactions, because it's completely pointless if it's placed like after, right? Like then they're not going to be making any profit. Then they're not going to like benefit from any arbitrage. So, like there's a paper that's been published by researchers at Imperial College London, which tries to quantify the value of these MEV attacks and how much has been extracted, right? And over a 32-month period up to December 2021, more than 750,000 sandwich attacks were executed on Uniswap, V1, V2, and V3, SushiSwap, and Bancor, with a total profit of $174 million. So that's significant, right? But as you can see, obviously, like if you divide, it's the amount of profit made per transaction isn't stratospheric. So 750,000 sandwich attacks for 174 million. It's not. I mean, I'm not calculating the math right now, but it's not a significant amount of profit per transaction, right? But there have been a lot of sandwich attacks conducted.
What is the difference between a sandwich attack and the second arbitrage example you had gone through?
So the second arbitrage example was the attacker does not rely on their transaction to be placed in between the victim's transaction, right? In this case, the attacker just looks at the mempool, they find these large pending trades, and they say that, okay, there's going to be a change in the price. And then what they do is that it's a riskier form of arbitrage than than a sandwich transaction, because the sandwich attack will like go through in that exact same block. What the second example does is that they wait for the price to drop, and then in the next block they put their transaction. They can go and buy ETH on Dex B, and what they do is that they exploit the differences in prices between two dexes, while a sandwich attack exploits the differences in transaction on one dex.
Got it.
Right.
So that the additional dex is the only different variable.
Yeah, but then that means that
There's additional risk. Yeah.
Yeah, it's additional risk, and it's also like the transaction does not need to be placed in between the victim's transactions, right? Like it means that like the order in which the victim's transactions go through don't really matter.
Okay.
I mean, the risk is also that you'd kind of be predicting, right, that the price will fall, unlike a sandwich attack where it's included in the same block, so you don't have to think of anything. You just kind of do it, and it's happens in the same block.
Yeah, actually, I'm wrong about the amount of profit per sandwich attack. It's actually pretty significant. It's $232 per transaction per sandwich attack, which is quite a lot actually. In the grand scheme of things. So
I mean, if it's risk-free, then that's great, right? I mean, not great for us the user, but great for the miners, because $232 of free money is crazy.
Yeah, exactly. 174 million divided by 750,000.
Yeah, that's
232. Yep, exactly.
And this is after gas fees.
Yeah, profit of 174
this is
million
like
dollars.
not this is not revenue, right? This is pure profit.
This is profit.
That's that's significant for sure.
Yeah, that's huge. Cool. Okay, so then the next type of attack is one of the attacks that is the most dangerous to the security of the blockchain in general, right? So what happened? So this is called a time bandit attack. That's actually a pretty cool name. I think a time bandit attack is a very cool name. So in a time bandit attack, assume that an unmined or unvalidated transaction block can include 10,000 transactions at maximum, right? The current height of the block is at 5,000 transactions. And so let's call this H1, and H0 represents the block with 0 included transactions, right? So now assume that at height H1, the total stealable reward exceeds the reward gained from honestly validating the block. So like, when blocks are validated, validators get rewards for validating those blocks. So they get them in the form of ETH, right? So let's assume that like the transaction's been ordered until like, 5,000 blocks, right? And it's not been like validated yet. And what an attacker realizes is that in those 5,000 transactions, there's a lot more stealable value that they can make than the amount of value that they can get from honestly validating that transaction. So what an attacker does is that they can rewind the block to the original height 0 and use the MEV gained to subsidize a 51% attack that proposes a new block and mines a fork up to or beyond H1 and capture profits. Now, I know that this is pretty confusing to understand. So like, let's go through each component of like what I've just said one by one, right? So let's say that I'm an attacker. I look at this, I look at this block with like a height of 5,000 transactions. I can see, okay, I can steal this much amount of money. Now, what I do is, because I'm a miner, I can also look at these transactions, go like, okay, I'm like, proposing this block with this ordered set of transactions, right? I go in and like I reorder the block according to the amount of value that I can steal, right? I'm a miner, and I reorder the block as in whatever configuration I want to order it to, right? Now I capture all this MEV gained, right? So because I know that if this block is validated, I'm going to gain so much MEV. I'm going to use this MEV then as an attacker to essentially say that I'm going to propose a 51% attack, right? So 51% attack is where I gain, where I capture essentially the where I capture the validating power of the blockchain itself, right? So that is that I have control over chain because I have gathered 51% validate whatever transaction I want. I am the person who is essentially in charge of the entire blockchain. It's basically a centralized entity at that point in time, right? So I then use this MEV, and then I can then propose a new block and then mine a fork up to H1, up to that 5,000 transaction limit or beyond that, right? So at that like height, block height limit, I can then like order like the rest of the transactions, get that block submitted, and then and then essentially I can run off with all of my MEV, and essentially like what happens as a result of this is that the control of the blockchain itself is in the hands of this person, of this miner, and the entire blockchain is then vulnerable and completely like you can't trust it because because the miner is essentially controlling the entire blockchain. I'm gonna stop here and then I'll like continue onwards in terms of like the some of the caveats around this type of attack. Or actually, like, let me explain that first, and then like you can ask your questions. So this attack's obviously pretty difficult and resource intensive to pull off, right? Like you need huge mining resources to be able to control 51% of of any blockchain, of any Ethereum blockchain, especially. So what you need to do is you can rent cloud resources such as GPUs, because Ethereum is proof of work still. So you can just rent a lot of like mining resources and then capture then essentially capture the blockchain at a specific point in time, right? So given the impending ETH merge and the fact that GPUs and intensive computing resources will not be needed to validate new ETH transactions, it's possible that the likelihood of a time bandit attack could reduce when ETH merges and like goes on to proof of stake. So currently a 24-hour rental attack on ETH costs $21 million. So this is a lot of money, and the reward would have to be high enough to justify the time, effort, and cost to execute this attack. So on Ethereum, I don't really think that this type of transaction is possible, just because of the way that the network is distributed and the amount of resources that you need to get your hands on in order to execute an attack even for 24 hours. But with blockchains that have lower security requirements, the cost of pulling off this attack may not be as high. So this can put the security of another blockchain at risk. Now I'll stop here, and then we can go through some questions if you got any.
So like, let's say this happens on so firstly, can this happen on proof of stake blockchains? Or is it only?
Yeah, I don't think so. Like, I don't really think that, I mean, it can happen actually. Like for example, theoretically,
you would just need to own a lot of it, right?
A lot of it. Yeah, you just need to buy all of it off. Like, and like if the cost of buying it is not that high, then and it's so okay. In a proof of stake blockchain, the mathematically the way that you can assume if it happens is if the MEV that is captured in the block up until like a certain amount of time, or a certain block height is higher than the cost of buying 51% of that blockchain's native asset, right? So let's say that the
seems
MEV
kind of like, how would, I don't know, I just can't think of how that would.
It's not as feasible, really. I don't really think that see these.
I mean, if a time bandit attack happens, the blockchain is essentially screwed, right? I mean,
the blockchain is screwed. Yeah.
Right. So this is like a one-off thing that can happen. It can happen only once to a blockchain, and then it's then there's a 51% attack and the whole blockchain is compromised, right?
Yeah, the whole
And
blockchain is
then
compromised. And then, I mean, like you can rent it for, you can, rent these GPUs, let's say for like, 2 hours, and then pull off this attack, and then like your resources go away. So that means and then like, you can revert back to how the mining distribution was prior to the attack, but you always know that the security of the blockchain has been compromised for this attack.
right. Okay.
But doesn't this seem like the starting point of the time bandit attack is just is just front running again, and then what makes this a time bandit attack is what you do with that reward.
Yeah, I mean, like well, it's not what you do with the reward specifically, it's how you execute how you execute the attack, right? You execute the attack by trying to capture control of the blockchain's validation powers. That's not necessarily like what you do with the MEV you capture. It's just a method of executing the attack. So if you're like front running, so if there's enough MEV in a block to justify or like or make economically justify pulling off such an attack, then like you would you may do so.
So tell me, so the reason I said that was because you're saying that halfway through the block being formed, right? The list of transactions being formed, halfway through it, the attacker realizes there's a lot of value to be extracted, correct? And so he adds his transactions. He rewinds the block, so to speak, and adds his transaction to capture that value that he saw earlier, right?
Yeah.
So that is
Well,
front running.
Yeah,
Now
exactly.
Now the second bit is performing the 51% attack and the hard fork. So what is the point of doing the latter?
They can capture the entire value of MEV in that block, right? Like they're not going to be capturing only the MEV for like a single transaction. Or it's not going to be one arbitrage on one dex or like one arbitrage on another dex. It's going to be the cumulative MEV in that entire block that's theirs. And that's why they have an incentive to pull it off.
Okay.
I mean, the incentive is only if the MEV is greater than the cost
of course. Yeah. That's why they theoretically have the incentive to pull it off.
I feel like that would be a very, very specific situation, right? For the MEV to be greater than 51% of the network is, I don't know, it just seems counterintuitive in a way.
I don't think that this is like in terms of probability, like this is something that's very likely to be executed. And I'm like, actually, it's not likely to be executed at all, really. But I mean, it's an attack that can be pulled off, and the reason that you want to consider it is because of because the consequences of this attack are higher than the consequences of any other type of MEV attack, right? Because you're essentially compromising the security of an entire blockchain and rendering that blockchain absolutely useless, really, in the future, because who's going to trust the blockchain whose security can be compromised at any point?
Yeah. Then the attacker is also assuming that the reward of this attack is higher than the cumulative rewards he might achieve by just performing.
I mean, that's
in the future.
Yeah, exactly.
Okay.
I mean, yeah, it's not a very likely one, but yeah, I think that you guys have understood how this is going to work. But just to like clarify it again, just because like it's a pretty complex topic, just to go through how this attack occurs again. A miner looks at the transactions in the mempool. They can see that a block has been ordered to a certain height. By that height, if they can see then that the amount of MEV that they can capture from that block is higher than the value that they can get from honestly validating that block, then what they'll do is they can try and gain control of the blockchain itself by executing a 51% attack, propose a new block ordered with a set of transactions that maximizes MEV for the miner, and then essentially use the validating power that they have, the 51% validating power that they have, to validate the block that they have proposed, and then fork the blockchain in a different direction, right? And that compromises security of the blockchain. That's essentially how I would describe a time bandit attack as occurring. Perfect. So then the next attack is a transaction replay. So in a transaction replay, an attacker looks for pending profitable trades in the mempool. They copy the execution logic employed by the victim. They divert the profits to a wallet controlled by the attacker. They validate the new transaction locally to copy the execution result. And if the transaction yields a profit, then what they do is they just destructively front run the victim's transaction. So they just like bid up the gas fee much higher. And they essentially like, destructively front run the victim's transaction. The victim's transaction fails. And again, that same study that was done by Imperial College London found that 188,000 profitable transactions between April 2019 and December 2021 could have been replayed for a total profit of $35 million, which is essentially a profit of $186 per transaction, I think, if I've done the math correctly. 35,000 divided by 35 million divided by 188,000 is $186. Yeah. So that's also, quite high. So as we're finding out, the average amount of profit extracted, per transaction is actually not insignificant. And the last type of, attack that I would want to discuss is a bribery contract. So a user can bribe a miner to give his or her transactions preferential treatment. So a better price for a transaction on a DEX, right? So these bribes can be carried out through bribery contracts, and an even more unscrupulous miner could enter into several bribery contracts with multiple users and pick the most profitable one to complete. And so in the extreme scenario, a miner could be incentivized enough by a bribe to mine a block on an abandoned chain. So let's say that like there's someone has bribed a miner to go like, oh, the blockchain forked in this direction, but we want you to like mine a block in this direction, in the leftwards direction rather than the rightwards where the block is actually continued. So you're practically aiming to rewrite the history of the blockchain here and posing a huge risk to the security of the blockchain. But honestly, like, again, this is not, I mean, I don't really think that this is super likely, just because of the impact that this could have on the miner and the amount that the miner would have to be bribed by in order to, go through with such a transaction. And including, just the economic benefit would have to be stratospherically high for this to happen. And that's why it's just an extreme scenario. So yeah, these are the different types of these are the different types of MEV attacks that we can go through, that we'll go through on this podcast. So just before that, I want to ask if you guys have any questions.
No, I don't think so. I think the time bandit attack was the toughest thing to wrap my head around. Otherwise, it's pretty straightforward so far, I think.
Yeah, exactly. Cool. So I think that before we before we delve into some of the key statistics around MEV, I wanted to just very quickly show what the two different types of transactions that someone can look out for are, that how you can identify essentially MEV transactions, right? So firstly, you can see a transaction where the attacker bids gas fees higher than the victim to ensure that their transaction goes through first, right? So and then the second type of transaction is that the attacker bribes a miner to arrange transactions in a block to their benefit. So let me very quickly pull up a couple of examples of how these transactions actually look like on a block explorer. So let me just do that 1 second. I'll just share my screen, right? Give me a second. Right, can you guys see?
Yep.
Yeah,
cool. So this is the first type of transaction. I'll just put it in full screen, where a miner essentially where the attacker bids gas fees higher than the victim to ensure that the transaction goes through first. So the first one, this can be detected when there are one or more failed transactions with either the same or minimally lower gas price than a successful transaction right before it. So the failed transactions are either those of the victims or the arbitrage bots. So like you can see, like the gas price here is very, very similar. So these are
That's
all,
ridiculous.
yeah. So these are all, these are all failed, these are all transactions that are definitely engaged in some sort of bidding war. The second one that I want to show is when the gas price of the transaction is really low, like 0 or 1 GUE, right? So let me just expand this as well. Sorry, let me just lock the aspect ratio. Let me just expand this. And you can see, like in this type of transaction, right? Um, Put it in full screen again. Like in this type of transaction, when the gas price of the transaction is really low, and you can, then kind of essentially this is all in GUE, right? You can, and that's the units in which gas prices are denominated. The gas price here is 1 GUE, 1 GUE, 1 GUE. It just shows that the miner has been bribed by an attacker to arrange transactions of block to their benefit, right? And that's why they're not paying really high gas fees. They're like, individually going to the miners and saying, okay, I'll give you I'll give you, some money under the table. Can you just validate this transaction for me? Can you just order these transactions the way that I want them to be ordered, right? So these are the two ways in which that you can in which you can identify MEV transactions. There are obviously many types of MEV transactions, but these just represent a snapshot of how these look on Etherscan or any other block explorer. So now let's go through some graphs that highlight the impact that MEV has had on Ethereum. So the first one is the cumulative extracted value of from MEV, right? Like the gross profit that's been achieved to date. So let me just share my sorry, expand my screen again. So what you can see from this graph is that more than $667 million worth of gross profit has been extracted in MEV to date. And there was a huge spike in summer 2021. So as we covered above, MEV transactions occur most frequently in periods of high network activity. So this tallies with the uptake of crypto activity in last year's bull market, right? So you can see now that growth and activity is somewhat plateaued since Jan 2022, although more than $114 million has been captured only in this year. So it's much higher than 2020. So where only around like $75 million worth of value was captured. So to a certain extent, this can indicate the general increase in activity on Ethereum since since then. Next, we can go through the cumulative sum of miner payments for MEV, right? So I'll increase the size of this again. And what you can see in this graph is that miners have been paid increasingly high amounts to extract MEV over the last 2 years. So this is around $240 million to date. It represents, I mean, this is a bit of it's not even a bit of a flaw. It's a huge flaw. It's why people are putting so much effort into, combating MEV. So these can be bribes, transaction fees, all of those, all of the above, right? So you can see these are huge impacts. And then the next, few graphs that we can go through are essentially the, the extracted MEV split by type, by role, and the distribution of tokens for profit taking, right? So arbitrage transactions account for it in, a huge proportion of MEV transactions. So, but a surprising amount of MEV has been captured by searchers, who are entities that actively look for MEV susceptible transactions of the blockchain as compared to miners, right? So actually miner income is lower than searcher income. So this indicates that in most cases where MEV is extracted, it isn't the miners who are the most malicious actors. So although they're obviously malicious since they reorder transactions for their own gain, rather they get bribed by searchers to execute their transactions, right? And the last thing is that wrapped ether is overwhelmingly the main token in which profit is taken, and it's probably because of the high liquidity that ETH has and the fact that it's the base asset across dexes on Ethereum. And wrapped ETH is also available across blockchains, so it gives it even higher liquidity and ease of use for attackers. So it's why wrapped ETH is like the main token that's used to capture profits, to capture MEV profits. Now, the last, well, this is not a graph, but just wanted to, highlight Arbitrage just ranked by their total profit. And what you can see here is that the top three arbitrageurs have made a cumulative profit of more than $80 million over the years. The top performing arbitrageur has made more than $39 million over 12,000 transactions. So just trying to see how much that is per transaction, and that's insane. It's $3,250 per transaction for the top performing arbitrageur in that range, right? So it's just a lot of money that's being made by these arbitrageurs on MEV transactions. Just gonna stop sharing now. But yeah, a couple of other important stats to keep in mind as well is that $1.4 million worth of transaction fees and 524 Ethereum blocks have been wasted on failed MEV transactions between Jan 2020 and December 2021. So the conclusion is actually pretty straightforward. MEV is a big problem. And it's a big source of value also for some in the blockchain ecosystem. But so we've touched upon so many aspects of MEV, but why exactly is MEV a problem? We've spoken about the risks that it brings to blockchain security, especially with time bandit attacks. But what are the other reasons why it's dangerous, right? So I can stop here if you guys have any questions. Otherwise, I'll just carry on.
No, I think go for it.
Just
pretty much.
One thing. When you said the second graph you showed, where the miners have been paid, right? Those are bribes, right?
Yeah, or it can be transaction fees as well. Like the it's not really only bribes. Like it's bribes plus the fees that they get from just the fees that they get from ordering transactions that the way they want to, or from essentially just validating the transactions, getting gas fees.
Okay, and second is, just a thought. The total value, absolute value of 670 million is definitely significant. But in terms of Ethereum's like market cap, right, of almost $200 billion, isn't there a case for it not being a very significant issue?
I mean, it is when like the value is just profit that's been taken by regular users and it's being exploited by people who are essentially validating these transactions. And the problem is that it causes a lot of risk in the system, and like it is still a significant chunk of money, right? Like the amount of money that these guys are getting per transaction is not insignificant, as we've seen. So that means there are losers. Like you can't only have winners, there are losers, and the losers are people who are submitting their transactions to the blockchain in the hopes of making a profit or any other sort of gaining on any other sort of value, right? So it's not really the case that it's not that in terms of percentage terms it's not that high. I mean that doesn't really matter. What matters is that the risk that it causes.
Yeah, okay. And I think it's also the fact that the source of this revenue is the retail essentially, right? And that's a detriment to UX and therefore larger adoption.
Exactly. Exactly. Cool. So just want to go through now a couple of things. The two main things that we go through over is just why MEV is harmful and some approaches to solving MEV, right? So two of the biggest risks that come from MEV are the security of the blockchain, from the incentive to conduct time bandit attacks, and to the decentralized nature of the blockchain, which is primarily due to the permission communication infrastructure that can develop between searchers and miners. So searchers are those entities that search for MEV transactions and then bribe miners to include their transactions, right? So in a scenario in which a few miners with extremely high hash rate or stake are able to collaborate and extract a very high proportion of MEV from the blockchain, they have the ability to control the manner in which transactions are included in the blockchain. They can control the future direction of the blockchain, And this just makes it no different from a centralized entity, but worse, since most people on the outside think that, the blockchain is decentralized and is working in their favor. The fact also that these richest bidders are able to trade against the poorest bidders, it just replicates the inequality that we see, in the world today, where, the rich make money off of the poor, the rich win, the poor suffer, right? So it's kind of like a microcosm of that on the Ethereum blockchain. And the centralization problem is exacerbated by block producers being incentivized to merge and form larger and larger entities. Because if you combine MEV strategies and capital to invest in MEV searching R&D, this increases the value that each producer gains on average. Again, same problems of Web2 and traditional finance. So therefore, this can just tend towards oligopolies or even monopolies, since the highest MEV extractors gain the most value. So this, it just leads to a flywheel effect where this pattern repeats. So it's a pretty bad situation. And another big problem that's brought out by MEV is just network load and the high gas fees. So all of these failed MEV transactions take up a lot of block space, and the bidding wars that they engage in, they just pump up gas prices. So it just makes it very difficult and impractical for retail users to transact on the blockchain. And you can see this in the gas fees observed on Ethereum throughout 2021, right? Yeah, so that's essentially the that's essentially the the reason that MEV is harmful. And before we get on to the approaches to solving MEV, just one thing that I want to highlight is MEV after the merge, right? So MEV is going to be as relevant after the merge as it is today, because the transaction ordering process at the core of MEV will remain the same. Validators will just replace miners. So there's some research that's been done by HackMD, and they estimate that with 160,000 validators, MEV can increase validator rewards by 75%. So they can boost ETH staking APR to 12.86% from 7.35%, right? So as the number of validators increases, the impact of MEV on validator rewards is meant to decrease. So for example, at 250K validators, MEV is meant to boost rewards by 60%. So the estimated reward after the merge is higher than the 5.6% received by miners today. It's primarily because of ETH issuance reducing significantly in its proof of stake system. So this indicates that MEV extraction will be at least as lucrative after the merge as it is today, right? So the composition of ETH whales and validators will also change. So one potential benefit could be that exchanges will be amongst the most prominent validators who they want to preserve their reputation and user base, so they won't engage in MEV extracting transactions the same manner as miners, right? Because miners aren't retail facing and they only exist as pure profit entities. But this again, you're just putting too much trust in a centralized entity, and they have their own agendas, and this problem of MEV doesn't need to be solved by putting trust in exchanges. It needs to be solved at a protocol level, right? So how exactly are entities looking to solve MEV today, right? So the first one to mention is Flashbots. So Flashbots is an R&D organization it's for profit, but it's aiming to mitigate and solve for MEV by quantifying and building solutions for it. It's currently at the forefront of identifying and tackling MEV in the crypto ecosystem. So mining pools accounting for 74% of ETH's hash rate today use Flashbots to combat MEV. So they want to do three things. They want to quantify and clearly identify the impact of MEV. This will help in creating tooling to combat MEV. They want to create an even playing field for the extraction of MEV. So they have a system called MEV Get that does this, and they want to distribute the benefits extracted from MEV to users and the general system over the longer term, right? So first, MEV Get. So Flashbot's primary product is MEV Get or the Flashbots auction. So MEV Get is a mechanism that allows users to indicate their transaction order preference in a sealed bid, so an anonymous auction process. So let's say that user A submits a fee of 500 GUI, user B's fee is 200 GUI, and user C's fee is 790 GUI. the transaction order will be C, A, and then B, and none of them will be able to see each other's bids. So this process enables block producers to order their transactions in a trustless manner, and this eliminates failed bids from the system. So it preserves block space and substantially reduces aggregate gas fee losses, right? So transactions only become publicly known after they're included in a block. So this list of pending transactions, so the mempool itself is a Flashbots mempool. It's a private mempool. The failed bids always stay private since they're never included in blocks. And it's designed so that trusted third-party intermediaries can't censor change transactions, right? So that's how MEV get works. Now,
one
okay,
quick
go on.
question on MEV get. So how is this implemented? Because and the reason I'm asking is because you're saying the user gets to set his or her preference, like indicate the transaction order preference. So like
It's not a I mean,
when you say
it,
user, do you mean a retail user or like who
I
exactly?
mean, like it means that like for example, yeah, it wouldn't really be retail users because retail users don't interact with MEV
Yeah.
get, right? But for example, if someone wants to essentially, like if you want to capture MEV from the from a system, like what Flashbots is assumed is that MEV is something that is going to be extracted from the system. Now, let's say that there are like these mining pool operators and they want to submit transactions to extract MEV, right? What Flashbots does is that it eliminates these failed bids by allowing for these transactions to be sent to MEV get. They have their own private mempool, right? And whoever submits these gas, gas fees for the transactions, these mining pool operators, they don't see other transactions gas fees. So it's private. So so the auction, essentially I submit one bid and that's the bid, right? And they don't post the failed bids on the blockchain, so that means that it doesn't take up block space and it doesn't waste like gas fees. And what this allows mining pool operators to do is to extract MEV without these issues. But it's not really, like, I don't really think that it's solving for the explicit problem of eliminating MEV at this point.
Yeah, and who is implementing MEV get? Because it's not a isn't
Well, it's just opens, it's just code. Like mining pool operators can use code in like when they're like ordering transactions and all of these things. When they get transactions to order and then validate, they just have to add the code that directs the transaction towards MEV get.
Okay, so it's a minor side implementation.
Yeah, I mean, like it's essentially a minor side implementation, but like we can see later on that they want to implement not MEV get, but this thing called proposer builder separation at a protocol level.
Okay, so these are like almost voluntarily the miners have to volunteer to use these let's
But
say.
they will, because they can extract more value, right?
Why would this
I
help
mean,
extract more value?
because for example, like it's a much fairer system in which like they don't have to pay for, in which they don't have to pay for the gas fees. Firstly, like the gas fees don't fail, and also that like for example, it's yeah, a fairer playing field allows for more value extraction in general. Although I don't know I'm not aware of like the exact dollar numbers in terms of how much more value that they can extract. But a fairer playing field and a loss of and essentially a lack of like failed gas transactions mean that they are saving more money.
Okay, so we're assuming that because of fairer playing field and this added benefit of no failed transaction and the associated gas loss.
Gas prices also like don't get as volatile, right?
Okay, so there are these additional USPs almost for this implementation, which might incentivize miners to use it.
I mean, which do incentivize miners to use them, considering 74% of miners already use them.
Okay.
Yeah. And Flashbots is actually one of the main reasons why gas prices on Ethereum haven't been as insanely volatile, in the last few months, as they were, last year or even in like summer 2020 with DeFi summer. So yeah, that's a pretty important consideration. So another and now another product that Flashbots is built is called Mev Explorer. So Mev Explorer just aims to track Mev activities on Ethereum. And some of the stats it tracks total Mev extracted, Mev extracted by DeFi traders and bot operators, gas spent on these transactions, how much MEV is extracted by which strategy, MEV extracted per protocol, and how much network resources have been consumed in MEV transactions. So all of this data can be found on explorer.flashbots.net. So those graphs that we were showing you earlier, they were extracted from this website as well, this dashboard. And it analyzes data from Aave, Compound, Uniswap, Curve, Balancer, Bancor, and 0x. And they want to expand to other DEXs and EVM chains in the future. So yeah, like MEV Explorer is also doing like a really good job of like actually making the problem of MEV very obvious and pertinent, right? So these are the two main products that Flashbots has come out with. And if you listen to the latest Bankless podcast, they actually on MEV with Stefan Gosselin, I think that's how I pronounce his name. They've also delved into MEV Boost, which is another product that's in the vein of proposer builder separation that we'll talk about later. And you should go and listen to that podcast as well if you want to understand MEV better, because they do a really, really good job of explaining it. Cool. So that's Flashbots. Now MEV auctions, right? So MEV, so Optimism, which is the layer 2 Ethereum scaling solution, they've proposed MEV auctions as a way of addressing MEV. So in this system, the functions of making sure there are transactions included in a block and ordering those transactions are split up. So now block producers propose transactions to be included in a block, and sequencers order the transactions. So these sequencers are chosen via an auction, which gives the right to order the last n number of transactions. So to get their transactions included in a block, users can pay the sequencers a fee, which is a bribe, or they can submit transactions directly to miners. So what this does is it clearly does not eliminate MEV. It just shifts it from miners to sequencers who have the same ability to pay for the privilege of ordering transactions, right? And capital, again, like it just begets capital. So even though the auction aims to separate transaction inclusion and transaction ordering, nothing's really stopping one party from doing both inclusion and ordering functions. So you're not really changing too much. And auctions may even increase the total amount of MEV in the system, since the right to order multiple blocks is auctioned off rather than the one block miners can validate at a time today. So, I mean, I don't really see how this is a feasible system, and it might end up being pretty counterproductive as well. Right? So these MEV auctions, I don't know like how much sense they really make. But another solution that's been proposed is proposer builder separation, right?
One second. Before we go to that, Optimism,
Okay,
I
sure.
think they are the one who run the sequencer themselves, right? There's only one sequencer, I think, currently for Optimism, which is run by the company that is behind Optimism,
Yeah.
right? So that's even more centralized than, the way Ethereum currently works, if you think about it, because
Yeah, exactly. It
it's
is.
free money for them. For anyone who's using Optimism, Optimism can sequence it the way they want to and
Exactly.
make money.
Exactly. And it's a pretty big problem. And actually, I don't know if, but I'm pretty sure that they wanted to decentralize the sequencers. They wanted to like make multiple parties have sequencers, like multiple validators, etc., etc. But at this point in time, I don't think that they've done that. And actually, I mean, this speaks to like a broader problem with layer 2s in general, who are a lot more, who can tend to be a lot more centralized than Ethereum layer 1, but no one really talks about it too much.
Right.
Yeah. Cool. So just wanted to go on to proposer builder separation now. Right. So the builder's role in this situation is to assemble a block by ordering transactions, and the proposer's role is to validate the block. So what proposer builder separation does is that these roles are separated, and it mandates that the proposer must accept the block with the highest proposer fee for the block builders. So let's say that there are these builders, there are multiple builders, right? And they all look at these transactions and say, okay, I want to order in configuration A. I want to order these transactions in configuration B. I want to order these transactions in configuration C, right? And then they all attach proposer fees on these transactions. So let's say that builder A has a fee of like 100, builder B has a fee of 200, and builder C has a fee of 300. Now a proposer has to accept builder C's block, right? Because it's the highest proposer fee from the builder. And proposers also cannot see the contents of the builder's submissions, since they can maliciously copy the contents of the submissions into their own blocks, and then they bid much higher fees to include that to ensure that their transactions go through first and they capture MEV. So this system mandates that the proposers don't see the contents of builder submissions. What proposer builder separation tries to do is to make sure that the validation of transactions remains as decentralized as possible, right? Under proposer builder separation, builders first look through the mempool, they order the transactions, create the most profitable block, and add this fee on top. And the proposer is selected from the validator set. And the proposer then looks at all these blocks submitted and selects the one with the highest proposer fee. Two takeaways from this. Firstly, builders still get to extract MEV since they can order transactions in a block. So given this power, all the problems with MEV that we spoke about above still exist. But what a counterpoint to this would be that if the proposer fee is high enough to, let's assume that the proposer fee is like most of the value that's captured through this block, right? In order to make sure that the transaction goes through first. If proposer fees stay that high and they are, close to the value of that block itself, right? Let's say that the value extracted from that block, including, gas fees and MEV is 15 ETH. And let's say that the proposer fee is like 14.5 ETH, right? And then let's say in another block, the value captured is 10 ETH and the proposer fee is 9.7 ETH, right? So in this case, like obviously the highest proposer fee will go through. So the 14.5 ETH will go through, right? But essentially, why would a block builder have the incentive to insert their own transactions and extract the MEV if most of that MEV is just going to be going towards paying block proposers the fees, and the block proposer is just getting the benefit of doing it, right? So in this situation, the main way in which this transaction would make sense is if the block proposer and the block builder are the same entity. Now, I actually think that the problem is that Vitalik's actually said that, there's a thread on ethresearch.com where Vitalik said the proposers are totally able to be their own block builders. Now, if this is the case, then what's the proposer builder separation? So I think that there needs to be a mandate that, the same entity shouldn't be able to build a block and validate this. A caveat to this is that the mechanism that chooses the proposer may be able to make sure that the same entity does not fulfill both functions at once. So, then that ensures proposer builder separation. And then in this case, because of the high proposer fees, because of that assumption, then you're saying that the value of a builder extracting MEV is not that high, which means that they won't do it in the first place, right? So the proposer builder separation, in my opinion, rests on this assumption. And in a proposer builder separated system, the only difference is that the validation of these transactions is completed by proposers who have no skin in the game, so to speak, since they don't get any benefits from being able to order transactions and exact MEV. They just get the proposer fee plus the block reward when they validate blocks, right? So therefore, the validation of whether a block is composed correctly and is fit for inclusion in the blockchain, it becomes more decentralized. So I think that, like, if those assumptions that we spoke about hold around the proposer fee needing to be high enough for the block to be included first, then theoretically there isn't as much of an incentive to extract that much MEV from the system. So that means that if you do this proposer builder separation at a protocol level, then essentially this is then this system makes sense, and this is the system that MEV boost is going to implement for Flashbot's MEV boost will implement for after the merge, or like when the merge occurs, right? And you know, in the future they'll I guess want to make they do want to make it as part of a protocol level change in Ethereum. um so it's also important, again, just to ensure that there's no collusion between builders and proposers. Although, you know, again, this is mitigated by the random selection of the proposer from the validator set. So, you know, again, from a high level, it doesn't seemingly solve the problem of MEV extraction, but if the assumptions that we speak about hold true, then then you know, it can solve for it. So it, at all levels, it's just an improved strategy to fight MEV. And yeah, you know, just want to caveat this by saying that, you know, obviously this is a very technically challenging topic. My understanding of how proposer builder separation works may be incorrect, and you know, if folks who are listening to this have a better idea of this, please reach out and you know, spread the education, because this is a critical topic. And I think that it's very important for us to get it right. But yeah, these are essentially the main solutions that have been proposed in order to solve MEV. Right, so don't really want to go through too much more right now. But yeah, you know, hopefully it's clear by now. MEV is one of the most interesting, just technically nuanced, critical topics in this ecosystem. And today we've gone through quite a lot in terms of understanding what exactly it is, what the types of attacks are, why it's harmful, what some considerations are, how much MEV is there in the system, and you know, what some approaches to solving it are. And yeah, you know, like, that's essentially it from me. And you know, just wanted to see if you guys had any questions about this, and then we can wrap up.
No, I guess what we should cover maybe in a subsequent, episode is MEV on other blockchains, because this has been kind of very Ethereum heavy, but I'm sure MEV is way more rampant on other blockchains because, of the ease of, because the other blockchains are not as big and don't have as high market cap as Ethereum. It would be easier to conduct these different attacks that we were talking about on these blockchains, maybe.
Yeah.
So maybe
Yeah.
we should focus on all the other blockchains the next time. But yeah,
Yep.
otherwise it was a great episode, I think.
Cool.
Yeah, I concur. But I think there was one thing on the alt L1s and L2s. If there is there an MEV concept in on L2s? Is that
Yeah, of course. I mean, like, for example, the optimism thing is like MEV, right? Like, they are
Right.
essentially capturing value from the sequencer.
Right. So then I would just think that it's just not that much, because the MEV to Ethereum market cap is like 0.3, like 0.5%. So for the smaller blockchains, maybe it's not that significant right now. But I mean, fair point. Yeah, I think this overall is a very important topic.
I don't think comparing MEV to market cap is really fair, right?
It's
because
not fair.
it's completely
Why?
different. It's like transaction fees versus market cap, really, right? That's the comparison we're making here. Obviously, transaction fees for anything will be a small percentage of the total market cap of whatever you're trading in. So just because the market cap of Ethereum is so much doesn't mean that MEV is not that big a problem, because it's a small percentage. Because like, in terms of an absolute number, it's still $600 million that could have boosted the ecosystem in other ways.
Yeah, so I mean, the reason I made that comparison was just to give some to deduce some absolute number offhand for the MEV
Oh yeah,
amount
yeah.
on other blockchains. So what I meant was, if it's the same parallel, assuming, then say 0.5% of $10 billion is not that much.
I mean, yeah, but it
True.
like, these numbers do add up, like, to a certain extent.
Yeah, sure.
And yeah, sure, like 0.5% of like $10 billion may not be that much, but actually, like, the impacts are not only financial. The impacts are also like from a security perspective, and
from
also
that
from like
perspective,
a user harm perspective. So it's not only like the money that you have to look at, right?
Yeah.
I mean, as a user, it sucks that you go on MetaMask, you're trying to buy something and your transaction just doesn't go through.
Yeah.
Like that.
Or
That's
like your
what blockchains
transaction.
were supposed to solve, right? That it should be instantaneous confirmation of transactions, which is,
And fair.
this is still detrimental to it. And fair, yeah, exactly.
Right. And actually, even if it's not an issue right now, assuming the alternate blockchain scales, it will become a problem in the future.
Exactly.
Yeah.
Cool.
That's all. I think that's all from my side as well.
Yep, me
Perfect.
too.
So I think great episode, guys. Thanks so much for listening in. Please feel free to comment, like, share, subscribe, and if you've got any questions about this or any of the other topics that we've discussed, please feel free to reach out. All our links and everything are on the YouTube channel, Spotify, Substack, everywhere. So please feel free to reach out, and thanks for tuning in. See you next time.
So, yeah.
See you guys. Thank you.
Bye.